Two of the biggest companies on Earth reported results on the very same day. Both are spending enormous sums on artificial intelligence, and yet one saw its shares surge around 10% while the other was sold off hard. That is the story dominating global markets as we close out the week on Saturday, the 1st of August 2026. Microsoft posted record profit on the back of its AI growth, and investors could not buy the stock fast enough. Meta reported the same evening and got the opposite treatment, with the share price sliding. Then on Friday, the 31st of July, Apple delivered record revenue and still watched its shares fall. If you own a global tracker fund, a workplace pension, or any technology exposure at all, this week has quietly rearranged part of your portfolio. So what separates a record profit that gets rewarded from a record result that gets punished? The answer is simpler and more important than most headlines suggest. Microsoft's report on Thursday, the 30th of July, was the standout of the season. The company posted record profit, and crucially, the market accepted that its AI investment is converting into genuine earnings rather than sitting on the balance sheet as an expensive promise. That distinction is everything right now. Microsoft has spent heavily on data centers, chips and cloud capacity, and this quarter it showed the revenue arriving alongside the spending. The market response was immediate, with shares surging roughly 10%, a very large single-day move for a company of Microsoft's scale. For context, a double-digit percentage move in one of the world's largest listed companies shifts hundreds of billions of pounds in market value in a single session. That is not a niche technology story. It is a move big enough to lift entire index funds, and it explains why Microsoft's results and Meta's results sent stocks in visibly opposite directions on the same trading day. Meta's problem was not a lack of ambition. It was the capital expenditure guidance. Investors looked at how much Meta intends to spend on AI infrastructure and decided that the guidance was not cutting it, and the stock dropped. The market is no longer impressed by the size of an AI budget on its own. It wants to see the line connecting that spending to profit, and it wants to see it soon. Where Microsoft could point at cloud revenue arriving now, Meta was effectively asking shareholders for more patience while the bill grows. Analysts covering the earnings call flagged that the stock looked poised for a fresh losing streak, and that pattern of consecutive down sessions is exactly what happens when confidence in the payback timeline weakens. This is the central divide of earnings season in 2026. The companies monetizing AI today are being re-rated upwards, while the companies still funding it are being asked far harder questions. Apple reported on Friday, the 31st of July, and provided the clearest proof that record numbers alone no longer guarantee a positive reaction. Apple posted record revenue and its shares fell anyway, because the outlook disappointed. Markets price the future, not the quarter that has just closed, and a cautious forecast can outweigh a strong historical result within minutes of publication. The call carried additional significance because it was Tim Cook's final earnings call as chief executive, closing a tenure that began with his first call back in 2011. Commentators have been playing his first and last calls side by side, and the contrast in what Apple was in 2011 against what it is today is remarkable. For shareholders, though, the immediate question is about leadership transition risk combined with a softer outlook, and this week they chose caution over celebration. Here is why this matters even if you have never bought an individual share. Microsoft, Apple, and Meta are among the largest constituents of global equity indices, so most UK workplace pensions and global tracker funds hold all three by default. When Microsoft surges 10% and Meta slides in the same session, your fund is not making a bet, it is absorbing both. The net effect this week has broadly been supportive for diversified holders, because Microsoft's weight in major indices is substantial. But the wider lesson is about concentration. A handful of AI-linked companies now drive a disproportionate share of index performance, which means your supposedly diversified pension is more sensitive to a single earnings call than most savers realize. Anyone checking their pension statement this weekend is looking at numbers that were largely decided in two announcements on Thursday evening. Alongside this week's results, a chart comparing today's technology market to the 1990s dot-com era has been circulating widely among analysts. The resemblance being highlighted is the concentration of market gains in a small group of technology names and the scale of capital being committed on the promise of a transformative technology. It is worth being careful here. The comparison is about market structure, not a prediction of collapse, and there is one crucial difference. Today's leaders are producing real profits at enormous scale, which many dot-com-era companies never did. Microsoft's record profit is the clearest example. But the parallel is a useful discipline, because the dot-com period also showed how quickly the market can shift from rewarding spending to demanding returns. Meta's reaction this week is arguably that shift happening in real time. The near-term direction looks reasonably clear from the evidence in front of us. Expect capital expenditure guidance to remain the single most scrutinized item in every big tech release for the rest of 2026. Companies that compare heavy AI spending with visible revenue, as Microsoft has done, should keep attracting a valuation premium. Those asking for extended patience are likely to face continued pressure, and Meta will now be under real pressure to demonstrate returns at its next update rather than restate the scale of its investment. For Apple, attention shifts to the leadership handover and whether the disappointing outlook proves conservative or accurate. Watch two things specifically in the coming weeks: any revision to AI infrastructure spending plans, and whether the gap between the AI monetizers and the AI spenders widens further. That gap, not the overall market direction, is the real trade of this earnings season. The lesson from this week fits in one sentence: the market has stopped paying for AI ambition and started paying for AI returns. Microsoft proved the point on the upside with a record profit and a share surge of about 10%. Meta proved it on the downside, where capital expenditure guidance alone was enough to send the stock lower. Apple proved that even record revenue cannot rescue a weak outlook. If you hold technology exposure, whether directly or through a pension, the question to ask is no longer how much a company is investing in artificial intelligence. It is when that investment turns into cash. Keep an eye on capital expenditure lines and payback timelines rather than headline announcements, because that is what actually moved hundreds of billions of pounds in market value this week.